Welcome back to the Daily Briefing for August 7th, 2026. Every day, our AI screens the market for high-quality companies trading below their intrinsic value, and we accumulate those picks through steady dollar-cost averaging, while new names keep joining the portfolio. The U.S. market has been rewarding software names lately, with money rotating back into quality growth stocks, even as investors stay cautious about stretched valuations elsewhere. Against that backdrop, today's screen surfaces 5 picks, all from the technology sector. Let's dive in. First, the portfolio update. Our July 7th cohort is mostly thriving. PayPal leads with a 32.6% gain and 30.3 points of alpha over the S&P 500. Workday is up 23.4% with 21.1 points of alpha. Adobe has returned 19.3% with 17 points of alpha. Autodesk 16.8% with 14.5 points of alpha, and Viva 13.4% with 11.1 points of alpha. On the losing side, Insulet is down 12.8%, trailing the index by 15.1 points, and Netflix is off 3.1% with negative 5.4 alpha. Among the newer entries, FactSet from July 15th is up 8.7% with 6.5 points of alpha. ServiceNow has gained 6.1% and Salesforce 2.9%, while Intuit from yesterday is down 1.8% and Tyler Technologies, added today, is flat. Overall, the winners are comfortably outrunning the losers, and the strategy's alpha remains solidly positive.
Adobe is the creative software giant behind Photoshop, Premiere, and a fast-growing digital experience platform. It tops today's screen with a score of 93.5, sitting 29.2% below its high, while ranking in the 97th percentile for cheapness versus its own valuation history. The market is pricing in slightly negative growth of about minus 0.2%, yet Adobe has compounded revenue at 10.5% a year, grown earnings per share 57.3%, and earns a stellar 70.1% return on invested capital on an 89.4% gross margin. That gap between priced-in pessimism and actual quality is exactly what this screen hunts for. The key risk is generative AI tools eroding the moat around its creative franchise faster than Adobe can monetize its own AI features.
Autodesk makes the design and engineering software behind much of the world's architecture, construction, and manufacturing, including AutoCAD and Revit. It scores 88.9 today, trading 25.8% off its high, and in the 97th percentile of valuation attractiveness, with the market implying just 5.3% long-term growth against an actual revenue compound rate of 12.9%. Quality is outstanding, a 92.4.
Salesforce is the world's largest customer relationship management platform, helping companies manage sales, service, and marketing in the cloud. It scores 82.7, down 29.5% from its high, and in the 95th percentile for valuation. And here is the striking part. The market is pricing in negative 3% growth, effectively assuming the business shrinks forever. Meanwhile, it generates a hefty 10.8% free cash flow yield, the richest in today's lineup, with earnings per share up 79.8% as margin discipline takes hold. Return on invested capital is a more modest 12.9%, reflecting years of acquisition-heavy growth. The risk is that AI-native competitors and slowing seat growth keep pressuring bookings, validating some of that pessimism. Workday provides cloud software for human resources and corporate finance, running payroll and planning for thousands of large enterprises. It scores 79.8 after a 31.3% drawdown, ranks in the 87th percentile for valuation, and the market implies only 2.3% growth, while actual revenue has compounded at 15.4%, an unusually wide mispricing gap. Earnings per share nearly quadrupled with 295.1% growth as the company pivots from land grab spending to real profitability. Our own position, bought on July 7th, is already up 23.4%, suggesting the market is starting to agree. The risk is that return on invested capital remains low at 11.1%, so the margin expansion story has to keep delivering to justify a re-rating. ServiceNow is the workflow automation platform that large enterprises use to digitize IT, employee, and customer processes. It rounds out today's list with a score of 77.1 after the steepest fall in the group, a 39% drawdown, landing in the 95th valuation percentile. The market implies about 9.9% growth, but ServiceNow is actually growing revenue at 22.4% a year, the fastest in today's screen, with earnings per share up 214.9% and a solid 19.6% return on invested capital. The free cash flow yield of 4.2% is the thinnest here, so this is the growth at a discount play rather than the deep value one. The risk is that any slowdown in large enterprise IT budgets would hit its premium-priced contracts hardest and delay the recovery.
That wraps up today's briefing. 5 quality software names the market is pricing for far less growth than they have actually delivered. The AI will be back tomorrow with a fresh screen, and every pick keeps compounding in the dollar-cost averaging portfolio. If you find these daily briefings useful, subscribe so you never miss one. This video is auto-generated for personal record keeping and is not financial advice. All investment decisions are your own responsibility.